Hi everyone, this is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profits newsletter. You'll notice that we are back to the whiz-bang Flash Gordon headset. I really just didn't like the sound quality of the last video that we did, so we went ahead and we're going to go back to using the headset until we get all this setup figured out. Really need to have some people who know a lot more about technology than I do to come in here and kind of improve the setup a little bit. Anyway, the big news this past weekend, well, you can pick your big news from the past weekend, was the Kentucky Derby with American Pharoah, earning his place as the favorite in the race as he wins the Kentucky Derby. It was a great race to watch. Of course, you had the Pacquiao fight against Floyd Mayweather, where Mayweather put on an absolute boxing clinic. I was very impressed that at 38, he can still play defense and counterpunch as well as he did throughout the fight. You had the Orioles playing a home game in Tampa, which was very strange. I did watch all three games, and there was just something just a little bit offbeat about it. Now, for most value investors, the really big event of the weekend was, of course, the Capitalist Woodstock out in Omaha, Nebraska, Warren Buffett's annual shareholder meeting. Now, this thing's covered everywhere on the web. There are some excellent transcripts and notes all over the web. So I'm not going to add my comments to that, but I do have some thoughts. First, I want to apologize for not getting a video out to you guys last weekend. Had it all scripted up, was ready to do it. Baltimore went nuts. My daughter lives about 3 blocks from Camden Yards. Those bars you saw on Saturday night getting absolutely trashed a week ago in the downtown area were their local neighborhood places where they knew all of the bartenders, the owners, the waitresses. My son-in-law had just left shortly before all that happened and headed back up to the house. So we were a little riveted by the coverage, making phone calls, trying to figure out how to get them out of there if things actually got too much worse. Fortunately, the scene and most of the trouble moved back to the northwest section of Baltimore. Now, unfortunately for those guys, but I felt a little better since, even as a married woman, she's still daddy's little girl. So we just never got around to the video, and I apologize for that. Anyway, I'm not going to rehash Warren's entire meeting. There's plenty of folks that will do that for you. But I want to make note of something that I think that Warren said that I think most people are going to gloss over and kind of ignore. Warren talked about the cash levels that he has on the books. He talked a little bit about where the market is, and he said, it's okay given where interest rates are, but if interest rates in fact go up, or worse yet, for equity investors normalize, which some folks I talked to would tell me probably be around 3% on the 10-year right now, then we have a problem, a big problem, and equity prices probably at this level are in fact overvalued. And what Warren touched on was Berkshire sitting on $67 billion in cash. That's a lot of greenbacks, folks. Now, he said he would rather have $20 billion after putting $40 billion in a great opportunity, but he just couldn't find any great opportunities at the current time, so they had lots of cash. When talking about the cash, Warren said, if any economic turbulence comes along, Berkshire's cash hoard puts them in a position to react. There's that word again, react, not predict, to everything that's going on. He'll be in a great position to capitalize on it when most investors are not. Now, that really flies in the face of that traditional Wall Street adage of stay fully invested at all times, no matter what's going on in the market. Don't you dare use common sense or anything like math and numbers to cut back your exposure to the stock market. Now, if you've been playing along or you're a subscriber, you know we have heavy cash levels in the deep value portfolios, more fully invested in the community bank side of things. We're simply not finding a lot of opportunities right now. Now, Charlie Munger at the Daily Journal meeting earlier this year commented that the way to get rich is to have a lot of cash in a checking account. He used the number 10 million. To have a lot of cash in a checking account when opportunity comes along. Now, he also said that it takes a lot of character to sit around for a long time holding stockpiles of cash, but that he didn't get where he is by chasing mediocre opportunities. Now, right now, if you look, the market's been up 6 years in a row, trading at a very high multiple on the S&P 500 from a historic point of view. We're seeing earnings predictions and guesses actually start to decline. First quarter earnings, just okay, and revenue's horrible. So being aggressive in the stock market, does it make a lot of sense right now? Maybe not. Let's go back and look at what opportunity really looks like. And I'm only going to talk about stocks that I actually wrote about or talked about at the time in a public venue. Okay, so I'm not cherry picking here. These are actual recommendations that I made back in 2009. If you remember the environment, the world was falling apart. Everybody was terrified of the stock market. Nobody wanted to be invested in stocks. I didn't want to be either, okay? I was just worried as everybody else. However, I have a simple rule. If it's cheap enough on the metrics, I buy it and let time and the valuation take care of things. Now let's look back at 2009 and what a great opportunity actually looks like in the stock market. Remember doing a piece after the kids and I got back from Disney. And even using very deflated local land prices at the time, I figured out there was no way on earth, impossible, for Walt Disney to be less than $39 a share. It was currently trading at $18 a share. You could buy it there all day long. That was not a one-off bottom tick type of trade. You could have bought it for an extended period of time. And of course, now it's many multiples of that price. Microsoft traded as low as 15, and again, it stayed there for a while. You had time to buy the stock at that price. Cisco was down at 14. Storage Technology got all the way down to $5 a share. Okay, now take a look at that price, STX, when you get a chance, and see what the face of opportunity in the stock market really looks like. Apple, on a split adjusted basis, traded below $20 a share, and again, that would have been 140 after the before the 7-to-1 split. You could have bought it there for an extended period of time, as panic had the market in its grip. Intel was $10, guys. You could have bought it between 10 and 12 all day long, locking up about a 4% dividend at the time, as I recall. Costco traded as low as 40. WP Carey, which now is converted to REIT, and the stock's been just a tremendous performer, traded for a long time because of their massive real estate holdings and real estate management arrangements, traded at $15 a share. You could have bought it between there and 17, again, for an extended period of time. That's what opportunity in the stock market looks like. Lots of panic. The guys on CNBC and girls, very nervous, upset, talking about the end of the world, economic collapse. You had major banks on the brink of failure. That's what opportunity in the stock market looks like. When stocks are very cheap relative to their asset value and to their future earnings power, as demonstrated by their past performance, these recessions and depressions don't last forever. And if you step up when the market's declining in the middle of one of these periods of what Mr. Buffett called economic turmoil, that's an opportunity. And if you've got cash to step up at that time, you're going to make an enormous amount of money. If you followed Wall Street's advice and came in fully invested, it's not an opportunity, it's a disaster. So paying a little bit of attention to valuations, to sentiment, and to what's going on in the world around you does in fact help. We're guided by the fact that we just simply cannot find any cheap stocks to buy. It's not just us either, guys. It's not just Tim Melvin saying, hey, gee, this looks a little pricey to me. I can't find a whole lot of stuff to do. At the Milken Conference last week in Los Angeles, and whether you love Mike Milken and the whole story with the Drexel Burnham thing, or you hate him, you need to be reading the Milken Foundation pages on a regular basis. They're doing some of the best research out there on education, healthcare, finance, the markets. The wealth of information on that page is just phenomenal. If anybody out there knows Mr. Milken, please let him know that I am in fact available to speak at the Milken Global Conference in 2016. It's my birthday week, but I would make an exception to make it to that fabulous conference that I follow very closely from afar every year. But they always interview some private equity guys, and this year was no exception. You had Steve Schwartzman of Blackstone, Leon Black of Apollo, and these guys universally were saying, look, valuations are really stretched. We're having a hard time finding stuff to buy. Both of the gentlemen I just mentioned did in fact say, hey, we're selling more than we're buying. If you go through and you look at the earnings transcripts of Carlyle Group, David Rubenstein and William Conway talking at that, and then Colbert, Kravis, and Roberts both said, hey, It's a great time to be selling. We are, in fact, cashing out and exiting a lot of our investments at very favorable prices. Now, this is the smart, patient money. It's not just me. Other valuation, oriented long-term investors are saying, look, there's just nothing to do. Distressed investor Wilbur Ross, a guy I've followed for many, many years, because every time I followed Mr. Ross into a deal, and I'm waiting to see if the Greek banks are the one that finally proves the exception to the rule. We'll see how it plays out. I've made a lot of money. Now, they've always been adventurous rides, and I've suffered many a 40 or 50% decline in a sector that Mr. Ross was involved in. But I've always ended up making money in the long run. I never go into one of those positions with less than a 5-year time horizon. He recently said in an interview that he's selling 2.5 times more than he's buying. So let's look at the world. We know we can't find a lot of cheap stocks outside of community banks right now. The oil stocks look cheap, but as you start to really grind into them, most of them aren't safe. There's very few that are cheap and safe. So we've got some that we found that we like long term. We're not finding any more to speak of. So, about 50% cash in most of the value portfolios, with the exception of the fully invested income portfolio and, of course, the community bank portfolio, where we're pretty close to fully invested at this point in time. So opportunity looks like 2009. I don't really think it looks like today, when Warren Buffett is holding on to $67 billion of cash because he can't find anything to do with it. Charlie Munger is making similar comments about his position over at Daily Journal, and he agrees with the cash holdings at Berkshire. These are two tremendously smart guys with fabulous track records. So are Leon Black, David Rubenstein, the folks at Kohlberg, Kravis, and Roberts, and they are also sitting on cash, selling more than they're buying. So let's think a little bit about what we're doing with our money, how we're approaching things. And there's a tendency, I know, to think of cash as the worst possible investment. However, as James Montier at GMO said, you've got to look at cash one of two ways, and you've got to decide how you're going to look at cash. Cash is either an incredibly powerful tool that you can put to work at the right time, or cash is a short-term drag on your performance, so you're going to remain fully invested and expose yourself to tremendous losses if, in fact, the market should pull back. Now, at the same time, Mr. Montier, who I consider one of the smartest value investors of this time, also said in that article with a Swiss business magazine in the fall of last year, in his opinion, stocks were egregiously overpriced, and he just simply chose not to play and was holding cash. So there you have it, folks. All the smart, patient money is pretty much saying the same thing. I'm not as smart as those guys. I am as patient as them, however, and I allow my decisions to be driven entirely by how many cheap stocks I can find. I cannot find a lot. We're holding a lot of cash. And after watching some of the craziness and potential market moving craziness coming out of Baltimore last week, some of the economic reports that I'm seeing coming across my desk that just show kind of a weak economy, the Fed's sort of in an impossible box. Worst job in the world for the last probably 7 years is chairman of the Fed, because you're in this impossible position where you have to keep stimulating the economy. It's great for Wall Street. It's been good for real estate. Not so great, actually, for the economy so far. And now there's pressure to raise rates, but raising rates would be an incredibly dangerous thing to do. Had a long talk with Louis Navellier, the growth stock manager, last week, and he basically just said, look, the Fed cannot raise rates. The economy's not strong enough. There's too much borrowed money out there. Remember something, if we took the rates up, 3-4% on Treasury bonds, that would be a huge blow to the U.S. government's balance sheet. So, worst job in the world. Janet Yellen only makes $199,000 a year. I know that's more than most people, but she's got much bigger problems at work right now than most people, in my opinion. So the smart patient money is positioned. They're ready. They can't find anything to buy, so they're just biting the bullet and holding cash for now. We might all think about doing a little bit of that ourselves. As Charlie Munger said, the way to get really rich is to have lots of cash when the opportunity does present itself. Anyway, we had just a great weekend this weekend. All at sports. Had a tremendous birthday party here in Central Florida. The wife made smoked up pork shoulder for 12 hours, turned it into pulled pork. Just a wonderful weekend. Looking forward to a great week ahead. Spring is even coming to my friends in the Northeast, and they're playing baseball again. And we're searching for stocks. We're looking. We're hoping to find them. We've got 13 Fs coming out here in a couple weeks. We'll be plowing through those. We are still finding some community banks to buy, so we're pretty happy about that because they are actually going to be a major beneficiary when rates do, in fact, start going higher at some point in the future. So that's where we are, and I want you guys to have a great week in the markets and in the rest of your life, and I will talk to you guys next week.